Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin. Hello and welcome back to Go Bank Yourself.
Go Bank Yourself!
Go Bank Yourself, the podcast where we are teaching people how to keep more control of their money by using a very specific strategy. What is that strategy called?
The infinite banking concept. As always, we are brought to you by Real Change Financial, our agency. And as always, there's the mention and the shout out in holding up the Nelson Nash book at the beginning of every show.
Becoming Your Own Banker by R. Nelson Nash. What a man. People come back to us and, we tell them what we're doing. We're building capital in whole life insurance policies, and we're leveraging those policies to finance major purchases and investments. And it's a very natural pushback response for someone to say, well, how does that help me? Why would I take a policy loan? Who cares about a policy loan? I can take a loan against my stock portfolio. I can get a HELOC. I can do all sorts of things. There's no reason to stock money away in life insurance because of a policy loan feature. Well, that is where we say people do not understand how policy loans work. If they only understood how beneficial the features of a policy loan is versus other types of loans in the financial marketplace, people would instantly have more clarity of why we do this in the first place. The simplicity of receiving a policy loan, the control that one maintains when paying back those policy loan repayments, and we'll get more into what that means, the interest calculation on a policy loan versus most other types of loans which are amortized. All of these reasons are why we're so big on this strategy. It's all important, and we're gonna get into today, into spreadsheets, into the numbers of how it actually works, the calculations, and let's show the people what we have, Penny.
In the book that we held up, there's a couple chapters dedicated to what would it look like if you used your bank. Let's be clear, your cash value inside of a dividend-paying whole life insurance policy. What if you use the loan feature of that insurance company to acquire something? We're going to stick with purchasing a car. And what would it look like if you mirrored the payments you're going to make to Bank of America or to Honda within the context of paying back your own policy loan from your own life insurance policy? A lot of this info is come to a head recently with a debate online from a really great channel, Better Wealth YouTube channel. Caleb
Gilliams is. I don't know him. I've never met him. Maybe I will one day at an IBC think tank. But I've been watching his channel way before he was this big. Before he had a real studio.
Is it because
it didn't look like this?
Is it because you guys go to the same beard grooming institution?
He and I were actually the same exact age, and we both had a daughter around the same time.
It's
pretty funny.
Doppelganger in Tennessee or something like that.
Yeah, and we're both 30, and we look like we're 18.
30, single? No, that's a Seinfeld episode. So, Chris Noggle is one of the best communicators about the infinite banking concept in online these days. But they had a debate about what's better, getting a loan from a bank, even a loan with a lower interest rate, or taking a loan against a life insurance policy. So, and this is like the third of 3 episodes where I think they both agree that big surprise, the life insurance policy has more advantages objectively and subjectively. But I wanted to go through an example of, this is a site called calculator.net, let's look at taking a $50,000 loan for a standard 5-year car loan, 6% from a dealership. I'm going to say that would be with some type of excellent credit or rebate that you could get 6% these days. But we'll
Yeah,
just leave that
definitely not on the
as
secondary market. And I've
right.
never looked into purchasing a new car.
Just wait until the people realize how much intrusion and tracking new vehicles do with a facial camera inside the dashboard to and kill switches. Just watch the premium and the interest rates on used cars. Anyway, for a 6% interest, 5-year loan, that would come out to $967 a month. And after 60 payments, the average American realizes, wait a minute, I thought I bought a $50,000 car. This is the cold plunge moment. I spent $8,000 on interest? Oh, yes, you are. And this is a little bit below the average interest rate. And this is just about the average cost of a new car in America. And you could look at an amortization table, how much of each payment is interest and principal. Not as bad as a mortgage, where a 30-year mortgage will be 90% interest and 10% principal. But hey, $250. And after a year, the interest is catching up. Well, the interest is going down. The principal is going up from each payment. Each payment, add these lines together, is going to be that $967. Till finally the last payment of that first year, there's $209 of interest within that last payment, and the principal on the loan has been driven down to $41,916. We're going to compare that to a policy loan. How does a policy loan work? Because we already know that at the end of 5 years, this bank or this finance company is collecting $7,998 in interest. What does a policy loan look like for a similar 6% rate, which is a fair rate? It's about the national average of all the life insurance companies we work with. But how does that loan work? So I just took a screenshot of the bank loan here at the top. And we're going to get heavy into, get your coffee, folks, life insurance policy loan calculation. So what we do here is show exactly how interest accrues in life insurance loans. Same principle, $50,000. And I'm making the same payments that I would make to the dealership, to the bank, $966.64 a month. The difference is that in a life insurance policy loan, 100% of the payment is knocking down the principal. So the formula here is simply the previous line minus the payment. There's a separate function going on, which is the accrual of interest. How much interest accrues in a life insurance policy loan? Well, it's the interest rate times the principal, and I divided by 12 to show how much that would be each month. In truth, if you had a policy, you took a loan and logged in, you'd see, 1/30 of this amount each day growing in your interest basket. So every time we make a payment and our principal goes down, again by 966, 966, 966, our accrued interest that month has to go down per force because there's less principal. Therefore, the calculation, which is still interest rate 6% times principal divided by 30, the accrued interest that month goes down until, as a whatever, we'll go back and see what the car loan, the bank loan was, but the last month's interest is $196 when we look at the life insurance policy loan. Over here was $209 from the bank. And from the bank, it was $41,900 remaining in principal. From the policy loan, it's $39,300 remaining. But we have shocking revelations for you people. Even if we're making payments to mirror how a bank loan works, meaning the responsibility to pay every month, they're still going to tally this interest and say, hey, Charlie, you owe $2,681 of interest. Here's the difference in our calculations. Now, if someone just won the lottery, a scratch-off ticket, or had the income, they're free to pay this. But we want to preclude that by saying we're being what Nelson Nash calls an honest banker. We're making payments each month. We're staying on top of that loan. So here's what we do. We're going to take that accrued interest and roll it into the principal. See how we ticked up from month 12 to month 13? Because we take the interest and roll it into the principal. Another caveat, loan rates are not fixed more than 1 year. I mean, there is a provision to taking a constant loan rate, but even your better loan rate will usually mean a lower dividend paid. So different discussion, different time, different can of monkeys. But we're making an assumption that 6% loan rate stays current for all 5 years of this loan. If so not, the interest... Go ahead.
Let's not go through years 2, 3, and 4, but let's jump down to year 5 and
Very
show.
Good. So suffice to say, we keep making payments as if we're just mirroring what we're going to do with the dealership. So what happens in the 60th month? The 60th month would be when you make your last payment, and free and clear, the loan's paid off. That what do we say up top? $7,000 of interest or $8,000 of interest was paid, and the car is yours. Ownership is another thing. Now the car is finally yours. Now the bank gives you the title. Until then, you didn't have the title. With a life insurance loan, in month 60, our example, there's $351 left to pay, and you go and make a $966 payment because you are mirroring the payments that you'd make with the dealership. So now you have technically an overpayment of $615. Where does that go? Because it can't go towards a loan. There is no loan. To be very technical, and we can address it another time, that would go in your paid up additions rider. That would be, you would squeeze that into your policy as extra cash. But then the piper must be paid. That last year's interest only tallies up to $340, so that diminishes your profit, and you can jump up and down because you made $275 doing it the IBC way. Are you going to write home about it? Dovi, you going to write home about that?
Just on that number, probably not.
Right. On the objective math, there ain't much to write home about. But let's talk about some other things. Subjectively, I think I made the calculation, and our vaunted life insurance company is collecting $7,700 in interest in this strategy, as opposed to the bank collecting $7,900. Or rather, you're only paying $7,700 in interest because the other $300, $275, you're putting in your pocket, or if you're smart, back into your policy. Mm-hmm. So there's the subjective points, though. How hard was it to borrow this money? Besides the fact, go back and read the discipline and patience one needs to even think about becoming their own banker. But you had to build up this cash before you borrowed against it, before you took a lien on your policy. Yep, it's not instant. They're not extending credit to you. No mutual is saying, thanks for your small policy where you're paying in $6,000 a year, here's $50,000 of a loan. No, you have to build it up. Secondly, the application process isn't mother may I, it's give it to me. I have the capital, I can take the loan. There's no credit check. There's no business plan. There's no haggling over rates. The rate is the rate. There's no proving up your income so they can decide whether or not they're going to give you the loan. And if you don't have a lot of income, there might be some personal guarantee on that loan. The guarantee on a policy loan is the death benefit. The ultimate collateral is the death benefit. Charlie over here passes away with $39,000 in unpaid loan and $2,600 in unpaid loan interest. It's coming off of his $1 million death benefit before his beneficiaries receive.
That collateral of the death benefit is what makes these $966.64 each month optional. If you're going to be an honest banker,
but very next point, flexibility,
and you want to use this as a real financial strategy, then you want to pay back this loan as efficiently and effectively as possible. But if something happens in your life where, you have to put a few months on pause, you're free to do that. You're the banker.
I reference often a client who we laid the best plan out for him. We consolidated his credit union loan with his policy loan, and he was going to save thousands on interest because the bank was charging him 12 and a half, or his credit union, and his policy, the minimum was something like 5.5. Now we set up a plan where he'd be an honest banker and he'd try to pay as much of that 12 and a half as he could, because that's what he agreed to with his credit union. More on that later, but the point was, then his wife got sick. And a year later, I say, how's it going? He says, I didn't make any payments. And in retrospect, without really being explicit about it, I thought to myself, wow, if you go to your credit union and say, I'm having a tough time, my wife is sick, can I get out of those payments? What's the answer? It's month 1 fee, month 2 nasty gram, month 3 collections and repo. There's no question about it. So here, who's obligating you to these payments? No one but yourself. The little angel and devil on your shoulder, skip the payment. You can skip the payment. And the angel on the other shoulder saying, no, pay the max. Pay your plan. Stick to your plan. You're going to make $315 a couple of years from now. Well, that's in this example. And that's when the interest rates. Example,
these plans can be so flexible that if you want to, pay a whole lot more of a monthly payment to yourself, you can set that up too.
Exactly, and with no fee, no early repayment fee, because unless you want to charge one, because you're the banker, you're making the rules of the loan. And
if I pay more than $1,000 a month to my policy, then I have to pay another $500 to my policy.
Then you have a sub clause. Read the contract you made to yourself.
Right. Also know the contract that your agent set up for you, because if you don't have enough room of PUA, then maybe there's only a certain limit that you can even pay.
Yeah, you might have to hold. Policy. Right, that's right. You might have to deposit your fee the very next policy year. A finer point. There is no. I said there's no credit check, but there's no reporting to any of the credit unions. A TransUnion and all the other two, Equifax, no,
Equifax, not Equitrust.
There's no reporting to them that, hey, Johnny's got a $50,000 unsecured line of credit. It's completely invisible to credit agencies. So in fact, if you use a policy loan to consolidate some other loan, all else being equal, your credit score has to go up a month later, because you've lowered, in the eyes of the credit agency, you've lowered your income to debt ratio. Your debt went down. That your car loan from a dealership or a bank mysteriously dropped by $50,000 and got paid off overnight. Well, they don't see that you took a policy loan, because if you value privacy, there's nothing finer than the privacy between two private parties, a life insurance company and the individual policy owner. Mm-hmm. A last note on ownership: when you take this loan out, you own the car completely, so you have the title of the car. You can then choose: do I want to, underpay or eliminate collision insurance? If someone else, if a financier holds the title of your car, they're gonna make you pay. Everyone has to pay liability insurance, but they're gonna make you pay a certain minimum of collision insurance. Different time for a different episode, or subject for a different episode of, Nelson Nash's approach to recurring payments to insurance companies that you hope you'll never cash in on, right?
We actually went deep on that a couple episodes ago.
Yep.
And a point on control: after the first year, you've paid roughly, looks like around $11,000 to your policy. Well, what if your friend comes to you and says, there's this great investment opportunity, $10,000, and you'll quadruple your money in 6 months? And, well, look, you've just been repaying these policy loans to yourself, to your policy, and all that money is liquid again. And you're in control of this loan. You can say, "Oh, I'm gonna totally change up my whole plan here, and pull that 11K out again, and come up with some new repayment schedule for
Yep,
yourself."
exactly. Um, you are the banker, you own the car, you have the title, and you are the boss. And you are the one who decides, do I make my payments or not? Do I divert, if I've paid back $11,000, do I want to take a second loan out for an advantage or an opportunity like Dovi says? Or do I want to stop making payments because I need to divert that money somewhere else? And there's no fees or penalties that are going to come. You're the banker. You make the rules. I have another example I want to go over, and this is more employing the discipline Nelson Nash talks about. This is, like I said, go ahead and put in the comments if you can find a 6% car loan, or what have you paid on a car loan lately? What kind of rates are you seeing on your brand new cars or used cars? I say they're closer to 8% when I've
On on
Googled
used
the
on
national
used cars.
level. Anecdotal, stories from people in my community that have bought new cars. I try
Yeah.
not to buy new cars. So here's where, because the bank rates change faster than life insurance companies change their rates, let's imagine that the life insurance company is still charging 6%, but the national rates have gone up, and you walked into that dealership and you were ready to throw down $1,013 a month because that's the 8% rate. Now instead of 8,000, it's 10,800 in interest on that same car. But you decide, I'm going to go for the policy loan again, but now I'm going to pay back the same 8% rate that the dealership would have charged me. So that's what Nelson is really driving at, about not only being an honest banker, not just paying the retail, but being strict with yourself. And if it arose in your thought, I can make that payment at the dealership. I want the leather seats. I want the highest trim level. I want the Blaupunkt radio with the quadraphonic sound. That was from Bull Durham, Dovi. Go back and not watch that movie. But if I was going to pay my dealership $1,013 for 60 months, let's do the same with the policy loan. And what happens is you drive down the principal faster, and the interest should be accruing. The interest should be driven down faster as well. But that last loan payment, month 57, there's only $300 left, and you're strict and you make the payment. Now there's no loan left. Now there's a surplus. The devil on your shoulder will say, stop paying. The angel on your shoulder will say, no, pay months 58, 59, and 60, because that's what you would have had to do. You make those payments, and now you have a surplus of $3,700. All right, tally up the last year's interest, $197, and there we go. There's a $3,500 profit. Not because the life insurance loan was cheaper, but because you used a financial thought experiment to pay the higher rate that the prevailing market, is currently charging vis-a-vis a car loan. Different ways to think about, none of that precludes the fact that when you borrowed $50,000, you're still earning your life insurance tax-free dividend on that $50,000.
That's what I was gonna say. Because in a way, you're making a profit. In a way, you're really just saving more money in a more efficient way. But where you're actually making a profit on this whole thing is you're still getting dividends this whole time.
Exactly. And listen, let's not go deeper into the weeds on the policies. By all means, like with every episode, comment, give us your questions. But I want to challenge Caleb and Chris to take a look at this and see how our numbers and our conceptualization of the policy loan jibes with theirs. So I'm sure the big collaborations are right around the corner.
Absolutely. We'll get there.
As an old friend and sales mentor once taught me, what's the difference between a big shot and a little shot?
What's that?
A big shot is a little shot that kept shooting. So
Kept
we're
shooting.
going to keep putting these out there because we do have great information. We think this really enlightens it peels back the curtain on the whole life insurance policies themselves and how these loans work and different scenarios for how infinite banking really works. Okay, you must, do not pass go, do not collect 200 until you've read the book. But the book is from 2008, or first version
It was
2000.
the fifth
So,
edition was published in 2008, but Nelson, he spent the whole 90s writing it, or
yep,
most of the 90s writing it, and it was first published in 2000.
yep. So, and it was the result of culminating or putting together his notes from the seminar. I think a full 2-day seminar he used to give on
Yeah,
the infinite banking concept. So,
right.
folks, hope that was enlightening, or if not enlightening, at least a little interesting. Did you catch the Bull Durham reference? Um,
Love a
so
good baseball
anyway,
movie.
leave us your thoughts in the comment section. Thumbs up if you liked it. Thumbs down if you hated it. We'd love to know either way. Dovi, take us home.
Well, thank you everyone for joining us. It's important to remember that we are not just life insurance salesmen. We really have honed in on how certain policies work with specific companies, structured in specific ways, and most of the life insurance industry doesn't even understand it themselves. It's
Good point.
it's almost sad to say that, and we're not trying to say, wow, look at this giant industry, everyone is so stupid, we're the only smart ones. There are just certain policies that can really be used effectively for banking, and that is not taught. Read Becoming Your Own Banker. What is it, page 234, where Nelson's talking about how he first started buying policies from his brother who sold life insurance, and when he was knee deep in terrible debt, and how this whole strategy came to be, he realized he had built up capital in these policies and he can access money at favorable rates in a favorable way. And his brother shortly passed after that, and he jokes that the first thing he's going to say to his brother when he meets him up in heaven is, "Why didn't you sell me more life insurance?"
Exactly.
And the answer is that his brother, who was trained by a large company, one we don't really use, but a solid insurance company, he didn't know it either. They didn't teach him. They weren't teaching
Yep.
this stuff. Nelson really learned it on his own. And it all came back to the way he thought. He was a very, very smart man. I don't
Anything
like
else?
I don't like when people idolize certain people and turn them into like this giant like god figure. And sometimes, dare I say, that might happen in our world with the great Nelson Nash. But if you read his book,
I thought you were talking about the president, but anyway.
if you read his book and some of his other books and listen to his talks, he was such a smart guy. He was really, really so wise.
And down to earth. So,
Yeah.
guys, thanks for tuning in. Catch us next time.
Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.